On April 29th, SoFi reported their Q1 2024 earnings. And after this report, the stock fell by almost 15%. So in this video, we are going to take a look at the major numbers that they reported and their guidance moving forward through 2024. If you enjoy the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. SoFi has had a very rough start to the year. The stock is trading down almost 30% year to date. However, a lot of that has to do with where the stock was trading in December, a little over $10. And we saw this company run up in a major way from November to December as the Fed announced that they were looking at potentially cutting interest rates in the back half of 2024. However, since then, we have seen a lot of speculation change around where interest rates are going to go in the future, as the Fed has indicated that they're a little bit more reluctant to lower rates in 2024, and we might not see rate cuts until 2025. And ultimately, this has a big effect on SoFi's business as they offer a number of different products that are all interest rate dependent, like personal loans, mortgages, student loans, and private loans. Even with these concerns, SoFi had a relatively strong first quarter. They reported an EPS of positive 3 cents and a revenue of $580.65 million. These were both beats compared to expectations from analysts. Anthony Noto, the CEO of SoFi, had the following comments about their first quarter results. Our first quarter was an exceptionally strong start to 2024, demonstrating significant momentum as we responsibly grow revenue and diversify towards financial services and tech platform segments, sustainable profitability, reinforce our balance sheet, and grow our member base. We delivered adjusted net revenue of $581 million, representing 26% year-over-year growth. Financial services and tech platform segment revenue combined grew 54% and represented a record 42% of consolidated adjusted net revenue, offsetting flat lending segment revenue given a more conservative approach in light of macroeconomic uncertainty. The first thing I wanted to highlight from this is their adjusted net revenue. It's sitting at $581 million, and you'll see that that's a 26% growth year over year, which seems very good. However, when we keep in mind a year ago, they were able to grow their revenue from the fourth quarter of 2022 to the first quarter of 2023. And now if we look at 2023 to 2024, we can see that revenue actually fell quarter after quarter, which is a little bit concerning. They were sitting at $594 million in Q4 of 2023, and that has since dropped down to $581 million of adjusted net revenue. I don't think this is a huge concern right now, but I do want to see this continue to increase quarter after quarter as well as year after year. Still, these are very solid growth numbers. Again, adjusted net revenue growing 26%, and if you look at it on a GAAP basis, their total net revenue actually grew by 37% year over year to $645 million. And SoFi's doing a very good job of continuing to grow their total deposits. This quarter, it grew by $3 billion, up 16% in the first quarter to $21.6 billion in total, with 90% of SoFi Money deposits coming from direct deposit members. And overall, direct deposit customers are massively important to SoFi's business for a couple of reasons. The first being the ecosystem that SoFi has built up. They have SoFi Money, but they also have SoFi Invest. They also have lending products. Getting customers in using SoFi and direct depositing money into their accounts makes them more likely to use a lot of SoFi's other products. And this is huge for SoFi as they can continue to grow out those other sides of their business. The other big benefit is interest income. They can get more interest income when there are a lot more customers coming in and putting their money in SoFi accounts. And net interest income has become a very large part of SoFi's business, coming in this quarter at $402.7 million, which is up 71% year over year or 3% sequentially. And I don't expect this to slow down anytime soon. Going into this quarter, I personally was expecting them to grow their members by anywhere from 35 to 40%. However, they came in and they grew their members by 44% year over year, bringing in 622,000 new members, which is the second highest quarter in the company's history. They're now sitting at 8.1 million members. Over the last 6 months, I've been paying close attention to SoFi's lending business, and this quarter they saw their GAAP net revenue fall by about 2% to $330.5 million. On an adjusted net revenue basis, it was basically flat year over year, coming in at $3 $325.3 million. And when you think about this, it really makes a lot of sense because of how interest rates have changed over the last couple of years. People are going to be looking less and less to take out loans, whether it's student loans, personal loans, home loans, whatever it may be. They're not wanting to take out loans because they're having to pay a lot more in interest related expenses. But the reason I've been paying close attention to this side of their business is because if we do start seeing interest rates coming down and the Fed loosening some of their policies, we could see this side of SoFi's business really take off as people look to either refinance away from their higher mortgage rates that they've had over the last couple of years, or even be more willing to take out auto loans, student loans, whatever it may be. And a lot of times that will be gradually working in SoFi's favor as people will look to refinance to a platform like SoFi. So far, SoFi's report has looked relatively positive. And if we look at their F24 guidance as well, it is also positive. They brought it up this quarter from where they had previously put their numbers at. Previously, they were guiding growth for an adjusted net revenue of 14 to 16%. This has been brought up to 15 to 17%. They also slightly brought up their adjusted EBITDA. They increased their GAAP net income in a massive way to $165 to $175 million, and their diluted EPS increased slightly to 8 to 9 cents for the total year. So why is it that SoFi's stock price fell by almost 15% in just a couple of trading days? And really what it boils down to is their guidance for the second quarter of 2024, and specifically this adjusted net revenue of a range of $555 to $565 million. The reason this sent the stock lower is because analysts were expecting the second quarter to come in with a revenue of $590 million. And we can even see that shown here on Yahoo Finance. They have a range of revenue estimates from $558.1 million all the way up to $605 million. So SoFi is actually guiding towards the lower end of this range, which is concerning to investors. So this lower guidance, as well as the decreasing in adjusted net revenue quarter after quarter for the first time in the last couple of years, brought up a lot of concerns for investors. However, me personally, I think that the member growth that we saw this quarter from SoFi just hasn't been translated yet into increased revenue. I think over time they will start establishing that, and that will help the company in a massive way. The fact that they are still able to grow their members by 40% year over year is huge for the company moving forward. Again, I was worried that they were going to slow down their member growth to 35 to 40%. So the fact that they're still sustaining 40% growth in members is a huge plus in my opinion. If we see SoFi continue to sell off, I'm going to be looking to sell puts below the share price, anywhere in the $6 to $5.50 range. That's where I think SoFi is a good value, especially anywhere below that for sure. But right now it's kind of in a holding period for me. I want to see it drop a little bit further before I would be willing to do that, because right now the premiums that you collect at $6.50 and $6 are just not there yet. I think we would need to see the volatility increase slightly more to really start increasing that premium that you would collect for those options. So keep in mind, less than 1% of my portfolio is in SoFi, and I wouldn't really add anywhere to 5 to 10% of my portfolio being in SoFi just because of the speculative nature of the company. It's still getting to profitability. It still needs to prove out its business model and show that it can sustain a profitable business model. So for those reasons, I'm not going to increase the stake to anywhere from 5 to 10% of my portfolio. I am comfortable at this 1 to maybe 2% of my portfolio being in SoFi. And I think that's something you need to keep in mind, especially on YouTube. A lot of these stocks that people talk about, they're not putting 50, 25, 30% of their portfolio in them. They're doing very small amounts because they are speculative. And that's something you need to keep in mind, because if you watch these videos and you see all the hype, you may think that these are very, very solid companies. However, they're not. They're a lot more speculative, and you should keep speculative companies to a minimum in your portfolio. So for that reason, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, how do you get a good price on a sled? Check the comments down below for the answer. Thanks for watching.